Welcome, folks. This is the market review for Euro USD price action for 20th of December. Yeah. So today we had this is a 15-minute chart. So we had two trades that were valid. So during the London Open kill zone, we had a run to the downside, and it came and took out the sell side residing below these lows and traded inside the fair value gap. That was at around at 2. So as you can see, we had this purple line denotes the midpoint of the fair value gap. So we had a run into that, and then we had a sharp reverse, and no candle close was below the midpoint, which is the consequent encroachment of the fair value gap. So when you see that, that is algorithmic, and price is showing you that the likelihood of it reversing to the upside, and we had this buy side liquidity that was resting above these highs. So we had that, we had run into that. So, and the way I always say, always make sure that you take something out of the market inside the fair value gap. It might not necessarily be this, the lower one, but at least this one, because this, if you take this price range from this low to this high, this will be in a premium. So it is good practice for you to take something out of the market at a premium level, so that you can put your stop to break even, and then you allow for your trade to play out, and then your targets to be these highs. So we had this run high, and then after that we had this run to the downside. We had also this inefficiency, and we had this order block right there. So we had that, and also we had these, as you can see, these are an inversion fair value gap. Let me zoom in a bit. So as you can see, this from this candle's low to this candle's high, that is, there's a gap. So that could be an inversion fair value gap, whereby you could use that even if you didn't use this. You use that, extend it forward, and as you can see, price respected that. And also, as you can see, that no, there was no candle close below the midpoint of the gap. So that shows that price is likely to reverse, and it is willing to move to the upside. So we also had a clear buy side that was residing below these relative equal highs. We had also this inefficiency. We had this inefficiency. So that was a draw on liquidity, and eventually the buy side that was residing above. We also had this inefficiency right here. As you can see, price reacted to it as of now. This is a live chart, so that is where price has reacted off of. So as you can see, it went to the midpoint. Didn't quite get to the midpoint, but at least went to the lower half. That shows that it's heavy and it's willing to move to the downside. So as you can see, we're also having this inefficiency. So if you went short right there, you could be taking something out of the market. These are fair value gap. So we have that. We also have an inversion fair value gap right there. So price might likely reverse and then go into the buy side that is residing above these highs. So so we dive into a 1 minute chart, and we see how those trades would have been framed. So let's go to our mini chart. So here we are. This is the 2 a.m. Candle that went down, took out the sell side, and then traded inside the fair value gap. As you can see, no candle close was below the midpoint of the fair value gap, so that was signature that price would likely reverse, and this sharp drop down was kind of like a Judas, a false move whereby price would lure some traders to go short and then reverse quick on them. So we had that, and then we had a clear buy side that was residing above these highs. So we had a market structure shift right here. So as you can see, we had this swing high. Let me zoom in. We had this swing high. We had a candle to the left and a candle to the right, and we had this candle in the midpoint. So that was the high that was taken right there, and then we had this fair value gap, and also we had a volume imbalance right there. So we could have coupled the two of them. So this is how we could have done it. So whenever you see a volume imbalance and a fair value gap, you merge them and you use them as they are. So that was it right there. And then that was your entry right there. So you're placing your long position, entering your long position right there. Your stop below that low. You can place your stop below that low. It is always even safer to place your stop below that low, which is no problem also, but place your stop right there because you've already taken out sell side right here, so there's no need for price to come back down again. And also it could trade inside these the midpoint of this gap of this wick, because we treat wicks as gaps. So we had that, and our targets, these highs, you can see we had that high, we nailed it right there. Also we had quite a good run to the upside also. So we had if you could have held a little bit longer to these highs right there. So that was around 8.26R. That was the London Open silver bullet. So we had that. It was quite simple to see. It was very clear. We had a clear buy side, so you could be taking partials above these highs, midpoint. So you take your fib, as I always teach you. Take your fib, anchor it to the low, up to the high right there. So midpoint, you could be taking partials right there, so that you can go to break even or better, and then wait for price to play out into the, and hoping that it will get to your TP. So that was quite simple. It was very simple. As you can see here, we only use time as our base. So time should be always your base. So if you have not set your trading view to the New York local time, then this is it. You should be setting it right now. It should be in New York local time, because the algorithm will always refer to the New York local time. It doesn't matter where you come from, it will always refer to that. And this was a good trade, risking very little and anticipating for a very good risk to reward. So we had that was an 8-hour trade for today, and I guess that was it for the London Open Silver Bullet. So we had also the New York Open Silver Bullet. So we had this price action here. So the London Open Silver Bullet is always from 7 a.m. New York local time to 10. So we had this. So at around 7, we had traded down inside these 15-minute fair value gap. So we had that run down. So we had this low came, cleared the sell side right there, and then went high, came back again. So it's coming back again just in case. But you see no candle close outside the fair value gap. So that shows that price is really bullish and we anticipate for longs. So we had, as you can see, we had a market structure shift right here. As you can see, we had this high being taken out right there. Also, we could say we had this swing high also being taken out, and then we had this fair value gap. So you could have placed your entry right there and anticipate for a run high into the buy side that was residing above. So we also had this inversion fair value gap. So it is not wrong if maybe you could try going long, maybe here, because you saw a market structure shift, going long there, and then placing your stop right there. You could have been taken out, but still you can come in again because the narrative is still right and we anticipate for longs. So this was only to clear the sell side that was residing below these lows for people who went long right here. So we had that, and this was really close to the New York Open. So this brown dotted line denotes the New York Open. So we had this candle was the one that it was the 8 o'clock open of the New York. So we had that. So your entry, you could be going long right here, but for some reasons you want to be conservative of your entries, and you wait for a market structure shift, you wait for an inversion fair value gap, you wait for a confirmation for you to go long. So that was it. Place your stop right below these lows, because now price has already taken out sell side, traded to a real discount in this fair value gap. So you place your stop right there, and then you aim for these buy side that was residing above. So we had that. So that was a 10-hour trade, which was that. So could be taking partials above this high, placing a stop at break even, and then wait for runners up into the buy side that was residing above these highs, and also inside these inefficiencies for price to reprice to them. So that was it. So that's a total of 18R, risking 2R for 18R. That was okay. So as you can see, it has always been time and then price. So you just wait for time, and then you execute on your trade based on what you see on the chart at that particular time. So whenever it's time to execute, make sure that you execute within the silver bullet window of time. So that was it. It was quite a fruitful day, being very close to the holidays, but price has done a good move. So we had that, and then this is where price is at right now, and we anticipate maybe for around lower below these lows, and eventually these lows, maybe, don't know. But also there is this is always a not trading time, because it has already gone past 10, and within the kill zone or the silver bullet window of time is when you anticipate for a good trades to manifest and to happen. So when you have that in mind, you'll never overtrade, you'll never do wrong decisions, place wrong trades based on wrong ideas, because time is not on your side. So whenever you play around with time, that becomes the best that you can do. So I'll be doing a complete beginner course heading into January, because maybe some of us don't know this, whatever you are talking about. They don't know what's a fair value gap, they don't know what's liquidation, they don't know what's the times that we're talking about. So we'll be doing something about that, so that everyone can be on board, and we can be referring them to go and listen or watch that those videos, those tutorials. So, but in the meantime, I'd like to say this, that if you keep up showing every day, just keep on keeping on, everything will be very simple. You'll get these trades, they'll be easy for you to get them, because you've already back tested on whatever you know. You've already forward tested, you've read the tape. So if you keep on showing up every day, that will be the thing that will catapult you ahead of every other trader to get these sniper entries, to get these good risk to reward entries. As you can see, our stop loss are always so small, so we don't risk a lot in our trades, especially for something like the Euro USD. The spread is usually, in many brokerage firms, it's almost at zero, especially maybe on something like Paperstone, it's always zero. So as you can see here, we have 0, 0, 0, 1, 0, 2. So the spreads are very low. In prop firms, it's totally zero. So you don't need to worry about the spread of having maybe tight stop loss. So with that being said, I guess you've learned something today, and until I talk to you next time, be safe.